seems that we've seen somewhat of a turnaround on the JSE today. It's been marginal though. So how are you reading the market's picture right now in a context where we've got at least South Africa still very much in a slumber?
Absolutely. It's definitely holiday mode today, and we can see it just by the level of activity in all areas that we're trading in South African financial markets. Volume decidedly low and really a bit of a lack of interest. There was a bit of a pullback, I think, just as a reaction of the very strong markets we finished on last week, and also a bit of nervousness prior to the FOMC meeting, which is taking place today and tomorrow. That's the US Federal Reserve, and it is important to know what their result will be, whether they're going to carry on with quantitative easing, whether they're going to keep their interest rates at their present record low, because that will impact on the flow of funds globally.
What are you anticipating on that front? And as you say, a lot of focus on that FOMC meeting and the outcomes there, and many saying that if we see tightening do come to the fore, then we're going to see a weaker dollar or a lesser strength in the dollar emerge, and some commodity unwind to an extent, and that to a large extent why we should be so interested in that decision.
We certainly should be interested. The cost of credit in the US will impact financial markets and the global economy quite considerably. If they say that quantitative easing 2, that 600 billion asset repurchase program is going to carry on, then that will mean the continued flood of liquidity into markets that will help to hold up commodity prices. It will certainly hold up precious metals like gold and silver, and that will be good for South Africa, for our export earnings, for our trade and current account deficits, bringing them down, and also reflecting through to a relatively stronger exchange rate for longer than had been anticipated. And all of these factors once again add to the flow of funds into South African markets. So it is important. If though they say that we may be shortening the quantitative easing program, then they'll be looking forward, financial markets will be looking forward to their interest rates in the US going up sooner than had been anticipated. That may then strengthen the dollar, and it would lead to a cutting back in all of the huge short positions that they have been taken against the dollar over the last few months.
What's your view on the stance they should be taking in? Because I had Mark Ingham of Ingham Analytics in studio earlier this morning, and he had highlighted a questioning about whether the quantitative easing program has been successful to start off with.
Well, has it been successful? What did they intend to do? I think primarily to look after the US consumer, to keep them above water from a credit point of view. There are already a huge number of failing mortgages, and if they had to let that continue on, if interest rates rose too quickly, then we'd find that would ripple through to more problems in their banking sector, and they really don't want to have to afford that again. So I think they're more likely to keep it going for the time being, and I think that the rest of the world is just going to have to put up with a steady weakening dollar.
For how long, Ian? Because surely the medicine is going to have to be taken at some point.
Absolutely. The debt has to be paid eventually. I think what the hope is that with a weakening dollar, they could put themselves into a trading position where their exports become more globally price competitive, at least in the short term, before inflationary forces come through. And from that standpoint, they may be then eventually, hopefully, to trade their way out of this huge debt problem. I think that's the way they say it, and the huge increase in debt will be paid out of deflated dollars, and of course that's no problem to them, but it will be for the rest of the world. The rest of the world may have to live with it, considering the size of the US economy.
So unlikely that we're set to see a turnaround in terms of their stance or monetary policy anytime soon. Let's talk about implications for the local markets, and let's start off with the rand for one, because it's been holding on to its strength pretty aggressively.
Absolutely. A number of reasons. The interest rate differential, of course. That has mean that foreigners who say come from the US or Japan with interest rates close to 0 or certainly well under 1% say, well, this is no reasonable return at all, especially with the beginning of an inflationary cycle starting. So they say, why not let's go and look for a higher interest rate in South African government bonds at 8 or 9%. That's a huge pickup in ongoing income. In addition to that, they've had a stronger currency. That meant the value in dollar terms has gone up. It's a double win, and I think that will probably carry on. They're looking at South Africa with better growth prospects than, say, their own home territories. So really, I think that has encouraged the foreign flow of funds into our markets and has helped to sustain them quite considerably. If there was any interruption in that, change in the US interest rate cycle, then I think it would be a negative signal for our markets, and certainly the growth cycle would come to an end.
The debate that's kind of quieted down over the recent past, and possibly simply because of the inflationary pressures we face, is whether or not a stronger rand is what the South African economy needs. So let's bring it back to that whole debate and what this means for manufacturers specifically, because it certainly makes imports cheaper, but that's
yes,
spelling stiffer competition.
Well, that's true, and perhaps in the longer run that is what we need. It sounds a bit heartless, but nevertheless we need to be able to compete in global markets on a price competitive basis in the long run. How do we do that? We have lower input prices. At the time when the rand is particularly strong as it has been recently, this is the time to consider investing in new fixed capital investment, to get the latest technology, to get the latest manufacturing equipment. Difficult to do right now, but the cost of credit is relatively low, the actual input price is relatively low. It's not good for job creation, I must say, and that is a big challenge we have to face, but I think that is the primary focus that we should be looking at.
When you're looking at lower input prices though, Ian, a lot of it is outside of the manufacturer's control. We've got that rising oil price, it's filtered through to the fuel price locally. We've got electricity prices coming to bear as well. So what are you anticipating in terms of PPI, for example, which is expected later this week, and the kind of pressure this is going to put on pricing moving forward?
Well, as far as producer inflation is concerned, we do expect it to have increased a bit further, and you're quite right to mention the major inputs there. There's fuel, oil, petrol, diesel, electricity, a whopping big 25% still to come through. The cost of food. Against that, you've had the lower commodity prices will partially offset that because of the stronger rand. But as far as a competitive base is concerned, the cost of steel, coal, oil itself, globally, every manufacturer worldwide is facing those sort of problems. So maybe that is a partial offset to some extent. As far as the manufacturing sector is concerned, we see it staying marginally positive, but not really particularly big great gains, and certainly nothing as far as job creation is concerned.
So when it comes to PMI numbers that are being expected early next week, what are you forecasting there?
We're forecasting it'll be around about the 52 level. Remember, 50 on the index is the difference between expansion and contraction in the industry. So we're expecting to remain marginally on the expansion side.
Taking a look at credit extension numbers, of course, that's just the other bit of economic data that we're anticipating this week. And outlook is or forecast suggests that we are going to see a marginal uptick in that regard. To bear in mind, though, is that we are coming off a very low base and within a market where the consumer is still highly indebted.
That's right. You know, I think if you just look at the consumer debt to income basis, it got to a highest level of 83% a year and a half ago. It's now down to 78%. Well, that's progress. But remember, when the cycle started 7 or 8 years ago, that ratio was at 50%. So, you know, there's a lot of downside there. I think that the consumers in South Africa are more in a mode of bringing down debt because of the lower level of activity, which everybody can recognize. Everybody knows somebody who's lost their job, and so caution will prevail. The banks also are not able, since the introduction of the National Credit Act, to advance credit at quite the same level that they did in the past. So all round it'll be a more responsible attitude, and I think the consumers are going to be reluctant to increase their debt levels too much just in the short term. So
Ian, where we've had you put on your economist hat for a short while there, let's take it back to the trader's desk here and take a look at how you're playing this market within this economic scenario.
with great caution right now. I think as far as JS is concerned, it is relatively expensive, not overly so. If we look at the PE on the Aussie, long-term mean going back about 15 years is about 14.5, and at the moment we're looking at about 15.5, I think. So it's a little bit expensive, but I think one has to be very careful about when to enter the market. I would see maybe there are a few occasions where one could top up existing holdings. I would look at the resource companies just because of the present high levels of commodity prices, but bearing in mind those are also very high, so I'd say cautiously to add to existing holdings, but not to take any big brave new moves right now. If you have to say, well, would I look at any particular stock, the diversified mining companies, say like Anglo and BHP Billiton, they've got such a wide spread of commodity bases and a good geographic spread. I'd say maybe that they are an area where one could still add to existing holdings there.
So largely playing to that old adage, sell in May and go away. What's interesting, Ian, is that when you're looking at those diversifieds today, we've got Anglo at the bottom of the top 40 today, down 1.5%. We've got BHP Billiton trading 0.6% lower as well. If you had to weigh up the likes of BHP against Anglo American, how are the two stacking up?
Well, I would say one big point in favor of BHP is it does have oil interests. Against that, Anglo has very big coal interests. So they're both in the energy field. But I would say from a management history point of view, over the last, say, 2 or 3 years, I think Billiton still comes out tops, even though it's in a difficult position in not being able to grow by acquisition because of its huge size and competitive forces which are brought against them. I think that would be my number one. But I would also look at Anglo. You know, you've got to say, hey, it wasn't so long ago it was at 500 Rand. It's been down to 330. It's now in that sort of 330 to 400 range. I would look to be picking it up in the lower level of that range, and with BHP on any significant pullback, I would say Billiton is also a pretty good buy. On
the opposite end of the continuum today, just looking at the outperformers on the top 40, we've got the financials ranking pretty strongly there. RMBH right at the top with a 2.75% gain. First Rand trading 1.4% to the upside. Standard Bank as well over a 1% gain, as is the case with Nedbank. What's your view on the banks at this stage?
Well, there's a lot of talk about corporate activity. That's just a euphemism for saying maybe there are international banks sniffing about. Well, we know about the deal that First Rand has done. In relation to the total value of their assets, it's small, but it's interesting that there is a definite deal on the go there. Standard Bank, it looks like they've taken the knock that they had to. They've cut back considerably. They've got their cost structure under control again. They've had to lay off about 2,000 jobs. That's a heck of a blow. But they've pulled back to what they know best, emerging markets within the African continent. And I say that that's positive now. There's not going to be any more big shocks like we had with the withdrawal from their Russian banking interests.